Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard.
Welcome back to the show, John. What's coming up today?
Jim, we're going to talk about what's new in the world of lithium in the James Bay region, and also a bit about my 2023 KRO Favorites collection.
So what is new in the world of lithium?
Well, on September 26th, the lithium carbonate price hit a low of $10.42 a pound, and that helped last week's sell-off in the lithium stocks, big and small, regardless the area or the type of lithium source they were targeting. And people started worrying, okay, we're having the lithium winter from the Lithium Mania 1.0 cycle that started in 2018 and ran until 2020, happening all over again. It's going to plunge into the $5 to $10 a pound range, where the better pegmatites still work, the ones that are 1% lithium oxide or better. But for many things, it then could raise the risk that, well, maybe it'll go even that lower, below $5 per pound. And this has been weighing on the market. But yesterday, a few days after the Golden Week in China ended, lithium carbonate prices have started to bounce up from the bottom. And they were up on the futures market. They were up limit yesterday. It does not look like this is a definitive demand-driven turnaround for the lithium carbonate price. What seems to have happened is that the refineries who take the spodumene concentrates and convert them into battery-grade lithium carbonate, they have been purchasing the concentrates at long-term prices. But then they're selling the lithium carbonate at whatever the current price is. And their margin has evaporated. And so they started to cut back on production. So this is not a turnaround in lithium carbonate demand that is causing this bounce, but the reality that the refineries, with the cost that they have for the concentrates, it makes no sense to continue converting them. So that creates a shortage on the lithium carbonate and will cause its price to bounce back. And so we kind of have this yo-yoing in this $10 to $20 per pound range. But the important price is that of a spodumene concentrate, 6% lithium oxide. That ranged between 5,000 to 6,000 tons last year. And I'm not sure how many contracts were written at that price. Most are being written down in the $2,000 to $2,500 a ton range. But the concentrate price has dropped to $2,325 per ton and still seems to be dropping further. And this makes sense because spot concentrate is the material that isn't already allocated to somebody's purchase contract. So if they're shutting down conversion, that means there's no appetite for the spot concentrate floating around. So that price will continue to go down. But the optics of that don't really matter because the offtake agreements that companies make are premised on the long-term expectations for their demand needs, and they have to also look at what is a reasonable price that allows the producer to make money mining and shipping the concentrate to the refineries. So even though the concentrate prices are still falling, that doesn't really impact anything in the long run. Now, the big development that caught my attention was that on October 11th, Hancock Prospecting, which is a private company owned by Gina Rinehart, made an announcement that it had reached 19.9% of Liontown resources, roughly about 438 million shares. And what had happened is after Albemarle made its revised offer that was only subject to due diligence, which was also its final offer at $3 Australian per share on September 4th. Hancock went into the market and on September 7th bought 59 million shares at an average price of $2.98. And then on September 11th, she reported that she had reached 7.72%, about $170 million. Now, during this past month, Liontown's stock price has held up quite nicely near that $3 stock price. And while everything else has cratered as we're watching the lithium carbonate price go down and the general mood in the world going negative about anything. But Hancock has continued to buy in the open market, and this announcement of 19.9% is very important because in Australia, a buyer of a public company who goes over 19.9%, in other words, 20% or higher, has to make an offer for all the outstanding shares. So this is probably the limit that Hancock would make without doing a formal offer. So on the 11th, also on October 12th, Liontown announced that the due diligence period, which was supposed to end that day, had been extended another 7 days. So apparently, most of the due diligence is done, but the Albemarle wanted 7 more days. And the reason is Albemarle is probably trying to figure out what to do about this situation. Because in Australia, this plan of arrangement that, it's not the kind where you issue shares of merge two companies shares together. This is actually a cash transaction, but the way it's structured is it requires a vote of shareholders. It's not just a hostile bid where you take everything that you get. This has to get 75% approval of all votes. And with Hancock buying at roughly $3 a price, it's not going to do this, a vote for this. It's going to want a higher price for its shares. So it's 19.9%. When you add that as a no vote to all the people who don't bother voting at all on these types of deals, Liontown will not get the 75% it needs for this for Albemarle to acquire the company and the Kathleen Valley project. So what's going to happen here? There's 2 potential outcomes. One is that Hancock is just trying to make some chump change, maybe grind a higher price out of Albemarle, and then the next week we will hear some sort of news that the price has been revised upwards, and Hancock will agree to vote for the transaction, and Albemarle will end up owning Liontown and the Kathleen Valley project. But the other possibility, which is very intriguing, is that Hancock, which is a very, very successful iron mining company, has ambitions to move into the lithium field. Now, amongst the big major mining companies, only Rio Tinto has grasped that as long as the lithium-ion battery becomes the basis for the electric car future, this market is going to grow into a $100 to $200 billion a year market. That's bigger than zinc or nickel. It's in the league of gold, aluminum, and copper. Iron itself is a $400 billion plus market, so that's like the biggest hard rock mining market in the world. So if Hancock is really there to push aside Albemarle and make its own bid, and if the Albemarle walks away and says, well, $3 was our limit and we're not going to get approval, we're gone, then Hancock has the capacity to make its own hostile offer to take over the entire company, and will probably get it. Will it lower the price because now there are no other options available for Liontown shareholders? Probably not, because there may be others in the wings who might step in and make a competing bid. But the important development here is that Gina Rinehart gets the lithium future and wants Hancock Prospecting to add lithium production to its iron production and grab part of this growing demand, which the IEA says requires 600% expansion by 2030 to meet the net emission, zero emission 2050 goals for the EV component of that. And if Toyota is not fooling us about its solid state lithium ion battery revolution, we're going to need 1,200% more lithium supply by 2035. So seeing this happen, this is a very positive sign for Lithium Mania 2.0.
What are the implications of the various outcomes for the James Bay Lithium Area play?
Albemarle has a 49% stake in Greenbushes, with Tianqi, the Chinese entity, holding the other 51%, and it has a 60-40 joint venture in Gina with Mineral Resources, which is an ASX-listed lithium producer and producer of other metals also. So the question is, if Hancock is indeed just trying to squeeze Albemarle to make a short-term profit, that's just because they can, or if it is muscling into the Australian lithium sector, that has two implications. One, Hancock itself won't be content with just Kathleen Valley, may have to go after some of the other big ones in Australia like Pilbara and Mineral Resources, but we'll probably look at emerging projects to grow its stable of lithium projects. So if it gets this stake, if it ends up being the ultimate owner of Liontown and is serious about moving into the lithium space, for sure its eyes will turn to the James Bay region of Quebec. And if Albemarle ends up being squeezed out, it already has purchased a 4.9% stake in Patriot Battery Metals for $109 million, valuing that project, the CV5 project, and the rest of the Corvette trend at about $2 billion Canadian. It's going to have to look more seriously in the whole James Bay region. So in this scenario where Hancock becomes the owner of Liontown, both parties will end up taking a harder look. But even if Liontown is just doing a little profit squeeze and Albemarle owns Kathleen Valley, Albemarle is a U.S. company, and it knows that the U.S. market, EV market, is growing. So it's going to still look at James Bay, but we won't have this additional major iron ore mining company joining the game of acquiring the best companies or bankrolling them, or in other words, injecting money. But at a minimum, the outcome will be that the Liontown shareholders are going to end up with about $4.3 billion US in their jeans, which they are going to deploy probably in the James Bay region. And my index, it's up now about to 69 members, and the additions have come from ASX-listed companies who in the last 5 months have done deals to acquire claims outright or to auction them from other parties. And this trend is continuing. The Australians understand that the James Bay region is the next Yilgarn, Pilbara, Creighton equivalent place to find world-class pegmatite deposits. Now, the James Bay region suffered some significant setback this year with the forest fire closures that started in early June and in many places did not end until August. 3 prime boots on the ground prospecting months lost. And some of the companies had 2 weeks in the field before they had to leave for the moose hunting season that runs between September 15th and October 15th. And the region right now, the stocks have slumped in the past month because people realize that most companies are not going to be in a position to drill their projects. And drilling is now the next stage for money to come in and push stocks higher. And the company that's right in the lead right now is Brunswick Exploration, which is drilling the Mirage property, where they have a corridor, 850 meters by 2,700 meters of spodumene-bearing outcrops. And what they're doing right now with their 5,000-meter program is they're trying to sort out the geometry of these outcrops. How do they hang together? And they're setting up a winterized camp, so they're already seeing enough in the field. And I talked about this last week to know they will be continuing to drill in January after taking a Christmas break. But you can tell that the market wants to see drilling, because last week, Ophir Gold Corp, which we talked about in a previous Kaiser Watch episode, it put out an update on the few weeks that it got done in the field, and it was a positive news release. They have, found more outcrop. They've got more samples pending. They're getting a better understanding. But it was clear that they do not have the targets sufficiently developed to mount a drill program in October, November. And this stock, which I had ranked as a fair spec value price stock in that sort of 30 to 40 cent range, the market immediately punished it and dropped it below 20 cents. The company that's next door to the Radis project of Ophir Gold, that is Q2 Metals with its MIA project. It's had an extra year of work on that project, has a better understanding of what its targets, pegmatite outcrops, look like. They do not yet know if they're dealing with an on-echelon series of short dikes like at the Allchem's Galaxy Sear project, or elongated pegmatite bodies such as Patriot battery metals found at CV5. And the drilling, they are going to start drilling on October 6th, or at least mobilize the rig to the property, because October 15th is the end of the moose hunting restriction in that particular area. That stock has not suffered in the market because the market is saying, yes, we are going to hopefully see drill confirmation that MIA is a significant LCT type discovery. And to me, this whole situation, we're heading into bottom fishing season. This is really quite wonderful that the market is unfairly punishing companies such as Ophir Gold, which is going to benefit from the what Q2 Metals learns with drilling the MIA targets, because it's within that same greenstone belt trend, and they'll be able to apply that knowledge to the information that they have, which isn't quite ideal for going in right away, but they'll actually learn indirectly from the drilling that their neighbor is doing. And the CEO, Sean Westcott, has told me we have $5 million in the treasury. We are doing the permitting to begin a drill program in late January. It's not as risky as if we were by ourselves in the middle of nowhere, because we will be able to stage out of the MIA winterized drill camp, and we'll have enough idea of where to drill these targets and hopefully come up with confirmation of also a meaningful discovery. And then once you have that discovery, it becomes a delineation drilling play. And that's what the market is wanting to look for right now. And we got an example of Dios Exploration Inc., which my KRO members have been buying. They put out a press release this week talking about talking about what was accomplished on one of their projects, Le Coron, and they said samples had been collected. They'd expanded the size of the property because they saw geology in the field that's prospective, that is not on the government maps, and they realized, the footprint of the potential goes beyond what we staked based on our multi-data set analysis and research. And but they didn't mention spodumene-bearing outcrop. Privately, the CEO, Marie-Josée Girard, told me that, we sampled 4 of the projects. We only had a few weeks, which I interpret to mean 2 to 3 weeks for the team to go to all these properties. We did find a lot of bush in these areas, which makes sense because this is a second order type of exploration play where it's generated by combining multiple data sets and triangulating, vectoring to where is the source of lithium values that are in tilled samples, and which of these government mapped pegmatite outcrops, which aren't large, it's what somebody in the field noticed and observed, but there's not the kind that stick out prominently in satellite imagery, so that would have been looked at and checked out a long time ago. So this second order exploration, that requires a lot more time in the field to see how these outcrops hang together. And we'll find out in November what the values are, which ones are LCT. It doesn't sound like they had an XRF or a LIBS gun in the field. But by November, no chance for a drill program in 2023, and also no chance for a drill program during the winter season. So my shareholder, my KRO members who are DL shareholders, they all had this negative reaction. Oh, dead money until next June when they get back in the field and start to develop these targets. But I think that reaction is unfair because there is a huge bottom fishing season focused on the James Bay Lithium Index member group emerging, because the players in there who are drilling can deliver results, and they will feed each other. And with Australian money coming in when this Liontown situation is wrapped up, and more companies looking for land in the area, even a junior that isn't in a position to drill targets until sometime maybe August, September of next year, by the first quarter of this year, they will have a lot more information about their targets and their prospectivity, and the whole, me too, repetition type psychology will kick in, and the capital will start flowing into the sector. None of the other metal markets have this sort of big picture story structure that lithium has. Yes, gold is cranking up today, but gold is this ephemeral thing that one day it's up, the next day it's down. There's no reason for it to be at $3,000 or even $1,000. It will just be what it is. So it's hard to really get long-term excited about gold exploration bottom fish. The market is quite negative with regard to this. The whole resource sector. And that's why with the Kaiser 2023 favorites, they have done very poorly this year, and they are likely to be put into bottom fish category as I sift through. And I've already done a preliminary search of companies with $500,000 or more, and the list is quite short of those that are interesting in terms of sort of capital, story, and management. And when I look at the charts of the ones that are more expensive companies that don't quite qualify as bottom fish yet, it is ugly out there. We're starting to see almost not ski slope type charts, but cliff-like charts, evidence of a massive capitulation going on out there. So my focus over the next 3 months will be the bottom fish collection for 2024, figuring out all the ones that have the potential to survive, a special emphasis on the ones that have James Bay focus, because I think that James Bay will achieve liftoff next year after this big delay caused by the fire closures. And I'm also making a special offer that anybody who subscribes for a KRO membership between now and the end of the year, it will expire at the end of 2024. So that's like maybe a 15% discount, but it also comes at a time where I'm not saying start buying bottom fish yet. I don't think they've quite bottomed, but this is a perfect time to look at those companies which are going to be probably end up lower as we head into tax loss selling season, and excellent time to pick up, especially in the James Bay Lithium Index arena.
John, thank you so much for the update.
You're welcome, Jim.
I'm Jim Goddard.
Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.